My orthodoxy today is that share prices are the best possible estimate, at least on average, of a company's value, of its wealth, and its future profits. And the reason why I'm choosing that orthodoxy is because I was stung by the 1.25 trillion valuation of the merged super company that Elon Musk created by blending together SpaceX and xAI. My argument would be that share prices are not a good estimate, that they are essentially rigged, that they reflect the power of big business in cahoots with big finance, sometimes central banks, often government, the power to manipulate share prices. They are more often than not a terrible predictor of profitability, even on average, I'm going to argue. I know this is a very controversial statement, and I can't wait for Wolfgang to start unpicking it. Let me offer two examples. One is, as I said, the merger between SpaceX and xAI, and the other is the dark art of share buybacks, which I will comment on a bit later. So let's start with the SpaceX-xAI merger. Now, when I read about it, my mind raced back to 2001. Does anyone remember that scandalous merger of AOL and Warner? That was a time, the dot-com bubble, when an old-singing, old-dancing internet startup, AOL, gobbled up the time-honored company, Time Warner. Now, here is what happened back in 2001, which is more or less what's happening now. To simplify the story of how these phony valuations are being put together, I want you to take an example of two fictitious companies that I just created in my head. Let's say there are two companies, both selling widgets, whatever. So you have the old-fashioned, traditional manufacturer, let's call it Good Widget. That has been going on for 30 years, has a track record behind it. And the new one, a startup, let's call it AI Widget, which has been going on only for a year, selling AI-powered widgets, let's say, right? Consider the following fundamentals. Suppose that you read in the Wall Street Journal and the Financial Times that, Good Widget has earnings of $5 billion a year per annum. And based on an annual growth rate of 10% over 30 years, its stock market capitalization is 50 billion. So 50 billion capitalization, 5 billion earnings, that is a capitalization to earnings ratio of 50 to 5, that is 10 to 1. Now, let's look at the upstart, the AI widget company, which is less than a year old or about a year old. And let's say that its earnings are only 2 billion during this year that it's been operating. And based on a frothy projection because of AI and all this hype, future sales per year are estimated to be 5% of a very large market, AI-driven market. And that has been responsible for AI widget having a very large capitalization of 100 billion, giving a capitalization to earnings ratio of 100 to 2, that is 50 to 1. Now, a rational person, a rational investor might imagine that Good Widget is probably a safer investment, even though its capitalization to earnings ratio is 5 times lower. But Wall Street trades on motivated irrationality. And here's how it works. Suppose AI Widget and Good Widget were to merge. Now, what would be the value, the capitalization of the merged company? A reasonable person would just up the two companies' capitalizations, 50 billion for one, 100 billion for the upstart, 150 billion. But that would be too timid, too conservative for Wall Street. Wall Street does something cleverer, something smarter. What they do is they take the projected earnings of the two companies, 5 billion for the old-fashioned company and 2 billion for the new one, and that gives us a sum of 7 billion. But then they multiply it with AI widgets' superior capitalization to earnings ratio. So 7 times 50 to 1, that gives us 200 billion more. That gives us 350 billion. That is 200 billion more of capitalization than the sum of the capitalizations of the two merged companies. That's a leap of 233.3%. Needless to say, folks, the fees and commissions of the Wall Street institutions that see this merger through is analogous to the marvelous big figure they miraculously arrived at. Anyone who thinks that these valuations reflect the company's true earnings capacity, I have to say, are either gullible or must have skin in the game of these false valuations. The fact that eventually these merged companies will suffer massive losses, and the mergers will probably crash and burn, like what happened to AOL and Time Warner, or another such merger, Mercedes-Benz and Chrysler. I submit to you that that's no evidence that the market gets it right on average. All it proves is that prices are wrong and can be wrong for a very long time, and then suddenly lots of people lose a lot of money before new prices are rigged once again. Before I go into buybacks, Wolfgang, get stuck into my allegation.
I have agreement and I have disagreement. I do remember actually as a younger journalist covering the Mercedes-Chrysler merger, and I completely agree. Most of these mergers have been a disaster. During my time when I covered the Eurozone crisis in the last decade, I noted that the bond market valuations, I mean, this is a different market, but it's also a market, were consistently wrong. And bond market investors are supposed to be more rational. So the idea that markets are can be wrong for long times is completely accepted. This is an uncontroversial statement. Free market enthusiasts would agree with you on that point. In fact, I would go further. I think markets are probably wrong at all times. The issue in terms of market capitalizations or in terms of market valuation, these are basically opinions that people form in real time all the time. So I'm not worried about this. I feel market valuations of all the problems that we have at the moment, and also problems with finance, the fact that we have bubbles or possibly bubbles is probably the least of our worries. I mean, I'm actually maybe less worried than you about the AI, the so-called AI bubble. It does promise significant gains, and I think it is perfectly rational for people to place bets on that. I once said jokingly, but last week when the Washington Post fired 300 journalists, I once said that AI could replace 60 to 80% of all journalists in newspapers. I think this will happen. This isn't just some polemic of mine. I think this will eventually happen. Now, if that's your perspective or if that's your belief, then you would be very rational to invest in AI, either in AI stocks or in companies. That's probably the smartest strategy. In companies that benefit from AI, in companies that use AI rather than those that make it. What these bubbles do, and we have to sort of accept that China and the United States both have different systems, but both have invested in 21st century technology. And we Europeans, with our banking systems and our sort of more sort of control systems, we did not invest in these areas. I'm not saying the capital market is the only way to do this. I think China demonstrated that there are other ways of doing this. The European way, the banking way, the old widget way, basically, that's not going to work.
Well, look, I'm not going to bite the bait and go down the AI rabbit hole because, by the way, my next article for UnHerd is going to be on AI. I've already written it. The reason is that I want to stick to my guns that this is not a question of errors. It's not a question of just bubbles. I'm talking about motivated irrationality. I'm talking about rigging the markets. There's so much power to create a false belief equilibrium, which is extremely lucrative for the people who create it. Let me now go to the second part of my tirade against the efficient market hypothesis. Buybacks, stock buybacks. This is part of the way in which markets are being rigged. Now, for the benefit of the audience, I'm sure you know what stock buybacks are, but let me just mention it. It's a practice of a company buying back its own shares. A practice that was outlawed by the Roosevelt administration's Securities Exchange Act, 1934, I believe, and it was outlawed until 1982, when it was legalized again. Now, the official story, what financiers tell us, is that there's nothing to see here, move on. That share buybacks are just another way of rewarding shareholders, another way of paying a dividend to the owners of the company that are entitled to extract profits from their own companies, from their investment. That's BS again. I'm sorry for saying it in such unscientific terms. There's no doubt that both dividends and share buybacks enrich shareholders. But that's where the similarity ends. Technically, the difference is this. If you think of the company as a pizza with 8 slices, dividends are like an extra sliver of a pizza that you can eat without any change in your ownership rights, a sliver over which, of course, you must pay tax. A buyback, in contrast, is the equivalent of the management of the company buying 2 of the 8 slices of the pizza to destroy them, to put them in the bin. The result being that you now own 1/6 of the pizza without having to pay taxes until you sell some of these pieces. But meantime, you're able to benefit from the type of the fraudulent mergers that I was discussing earlier, the ones that are based on manipulating artificially boosted valuations, right? Another way of understanding the difference between dividends and share buybacks is this. Handing out a larger dividend signals the company's confidence of higher future net earnings, but it comes with a dilemma. On the one hand, shareholders love higher dividends, even if they have to pay tax on it. But on the other, if the dividend is too large, outside investors may start worrying that the firm's profitability in the future may suffer from underinvestment, in which case the share price may fall when dividends are deemed to be excessive. But that's not the case with buybacks. All that company directors do is spend the company's cash, sometimes cash that has been saved by firing lots of employees, and they use this cash to buy their own shares. Share prices go up, and shareholders who keep their stock get a tax-deferred benefit that compounds with time, and that's very important. To put it differently again, a higher dividend signals confidence in the future growth of the company. In contrast, the rise in the share price due to a buyback signals the value-destroying ransacking of the company's cash pile. And why they do it? For the purposes of creating tax deferrals that push the valuation higher to help Wall Street rig share prices more efficiently. Now, this is why Roosevelt's New Dealers very sensibly banned share buybacks in 1934, but also why the new kleptocracy that emerged on the coattails of Thatcher and Reagan legalized them. Between the way Wall Street overvalues mergers and acquisitions, stock buybacks, and central bank money being used to fund all this, including the stock buybacks, the notion that share prices reflect the true values of the company is nothing short of bad, sad, toxic jokes. I rest my case.
I completely agree with you on this point. What happens here is this isn't free market. This is an institutional bias in favor of a particular system. And in the case you mentioned, this is a rigged tax system that favors share buybacks as opposed to dividends. And that's why people are doing this. So the solution is, it's not an argument really against how capital markets work. It's an argument against how governments and central banks, in fact, engage with them. I've always believed that central banks should stay out of this. In fact, I also believe that central banks should not support markets during financial crisis. I think we talked about this before, global financial crisis was a big factor in the decline of sort of liberal democracy in Europe, the lack of support for it. It is the way central banks engaged with the markets and created inequality and contributed to some of the economic tensions that have built up. If I recall back, I think this started really in the 1990s with the Greenspan put. When there ever was a crisis, Greenspan would just cut the interest rates and always support the financial markets. And that was sort of my first inkling at the time when I thought, something would go very wrong in the economy later. That was in the 1990s. These are institutional biases that we've built up. That has nothing to do. A free market doesn't need institutional biases. A well-functioning capital market, should be neutral. It will make mistakes. It will be irrational pretty much all the time. And that's fine. I don't actually care very much about this. This is in the nature of the beast. When public policy, through taxation, through the way monetary policy works, through fiscal policy works, discourages or creates these imbalances, then that's clearly wrong. But your point isn't one about markets. Your point is one about policy.
Well, we are struggling to find disagreement between a German liberal and a Greek socialist. But I suspect that the point of agreement is that socialism for the bankers and for the financiers is not a good idea, whether you are a liberal or a socialist, right?
Absolutely.